Bank of Canada just cut rates by 25 basis points to 2.5% on the overnight rate. This is the first cut that we've seen since March of 2025. And you're probably wondering what this actually means for your mortgage, the market, and are things gonna rebound? I'm gonna break that all down in this video. I'm not gonna make you wait. Let's get into it. Let's talk about the numbers that actually matter. Here's what happened. The Bank of Canada cut the overnight rate 0.25%. And the market's basically predicted this for the better part of the last week and a half as they watched a jobs report happen. I'll talk about that more below. When they cut the overnight rate, it goes from 2.75 down to 2.5%. And this means most banks are cutting their prime rates from 4.95 down to 4.7%. This is a direct impact on you if you have a variable rate or a line of credit or anything else based on prime. The only bank that's different than that would be TD, which cut from 5.1 down by 25 basis points. The numbers that matter, if you have a variable rate mortgage, if you got a $500,000 loan and you have an adjustable payment, which a lot of people do right now, you're gonna see about $65 reduction if you have a $500,000 mortgage on your monthly payment. Now, if you have a fixed payment variable rate, you're not gonna see a payment difference, but you are gonna be paying less interest. The math is simple. For every $100,000, it's about $15 less on your monthly payment. But here's the thing. If you're renewing your mortgage in the end of 2025 or 2026 and you still have a 1.5 to 2% rate, you're still probably in line to see over a doubling of your interest rates. So somewhere around the 4 to 4.5% mark. And I'm gonna get right into what's going to happen with fixed rates after I break down why the Bank of Canada cut rates today. So here's the economic reality. First and foremost, unemployment hit 7.1% in August. That is a big number. With a massive jobs report coming out just a week and a half ago showing the market is shedding jobs, the Bank of Canada had no reason not to pay attention to that information. Now, GDP actually declined, which is gross domestic product in our province. We went down to 1.6% in Q2. More importantly, inflation is at 1.9%, which is around that 2% target, depending on which measure you're looking at. Some suggest we're actually closer to the 3% target. And core inflation itself, which is the big measure that the Bank of Canada is typically watching and the one that we look out for as it relates to how hot the market is going and how fast your money is going down in value, is still hovering at about 3%, which is the upper range. And this is why some were suggesting maybe the BOC should not have actually cut rates today. So the reason they actually cut rates, there was three big reasons. Number one is the labor market. And this one is the biggest out of all of them. And they brought it up as the first consideration when they talked about why they cut rates today. First thing, employment has declined for 2 straight months. And the crazy thing is, and we talked about it previously in the channel, when the market declined, they actually were looking at a surplus, but we were negative 66,000 jobs. What is even more impactful is a lot of these jobs aren't just like everyday labor jobs, they're white collar positions in offices where these are people who actually make good money and they're losing their jobs left, right, and center. Hiring itself has slowed down in the entire economy. And when job growth declines, this is a sign of where the economy is and where it's going, which again means the BOC kind of has to react. Now, we've also seen inflation pressures easing. Even though we're upper 2% near that 3% margin in core inflation, we've seen Canada remove some of those tariffs, and as such, we're starting to see a slow rebound back to this normalized inflation. Again, the target for Canada's inflation is 2%, so we are at the upper limit of where they want to see it, but with it having eased from the past, there's still another reason for them to cut interest rates. And the third, and this is honestly the biggest one, I just mentioned it, which is the retaliatory tariffs being removed from the United States. This could have a ricochet effect and reduce the cost of goods in many situations in the country, which could ideally and hopefully put downward pressure on some of those inflation metrics that they look out for. If you have a variable rate or a line of credit, your mortgage just got cheaper. Hooray, everybody's excited. This could mean that some of the banks actually increase the prime discounts, which means instead of getting prime minus 65, maybe you're now getting prime minus 50. It'll probably take a day or two for that to happen, but I wouldn't be surprised to see that happen in the next couple of days. If you have a fixed rate renewal coming up, as I mentioned earlier in the video, you're gonna go from 1.5 to 2% up to something like 4 to 4.5, depending on your situation. And you do need to be prepared for a potential payment shock, depending on your circumstance. We've done a few videos on what to do about mortgage renewals. Click the description below, and if you're listening to the podcast, click the link, it'll send you to the video explaining what to do about your mortgage renewal. If you have a HELOC and you're investing in the markets, or you're just using it in general to get by, great news, because those payments are actually gonna start going down. You're paying less interest. But the big question I think everybody's really asking about this is about affordability. Does this make housing more affordable in the marketplace, or does it create an opportunity for more people to buy into this current market? And the answer to that question, in short, is no, it doesn't. Yes, we see a small $15 per $100,000 drop on variable rates, but fixed rates have been less expensive for a long time. And as such, you're in a situation where you probably don't see affordability go up. Plus, this doesn't make it easier to qualify for a mortgage. So what's the impact on the real estate market? Really, that's the question. Is the market going to take off or keep crashing? If you're a buyer in this market right now, you could see a little bit of an increased affordability if you were planning to go variable in the first place. Plus, you might actually continue to be able to take advantage of the high amount of listings. The stats, however, have shown that there are people taking their listings off the market as they're not achieving those high numbers. So there could be a slightly increased amount of competition. And anecdotally speaking, depending on which city you're looking at, I've heard that feedback already in September that the market has started picking up. This doesn't mean multiple offers everywhere or bidding wars, but it could mean the end of that cycle in a lot of different cities. Real estate has had some bumps and bruises over the last couple of years, but as an average, as a whole, it's been a sideways decline. The big question is, are we at the end of that decline with more positive news and lower rates? And if you're selling in this market right now, there's a little bit of a boost to buyer confidence, which means you could have some more people purchasing at your property, but don't overprice the listing. It makes no sense in this market. People know there's competition, they know there's choice, and they know it doesn't make any sense for them to go out and bid above or pay above what that property could sell for otherwise. So price it appropriately, price it to sell, and you're gonna get somebody to buy your place. Proceeding carefully. And they're taking a shorter horizon than usual. They're looking at this on a month by month, which normally they look over at a longer horizon. They basically said, don't expect any aggressive rate cuts. In English, basically, this could mean another rate cut or two coming, but they're not talking about a 0.5% or a 0.75% overnight. They're watching this over the long term, and they're waiting to see for any major data points. If you made it this far, you need to know the next rate decision is in October. The decision is that at this point, it's not likely we're going to see another rate cut. But there is suggestion that we could see this rate cut happen in December of 2025 before turning the calendar into 2026 of next year. He said specifically they're looking for US trade policy developments and more specifically employment data trends. Basically the same reason they made the decision this way, they want to see if that continues to unfold. Macklem specifically said they're looking for performance under the US tariffs, spillover effects to business, investment, and employment. Are we losing more jobs, hiring more people? Are people making more money? They also want to see if the trade disruption continues. Are we going to see the removal of the tariffs impact the trade and what's happening in the market? And last but not least, what are people expecting to happen from inflation? If we believe that inflation keeps going up, that's actually a bad thing. So they're looking out for that. If you have debt, you have a variable rate mortgage, this actually helps you out. If you're someone with a HELOC, thank goodness, the cost is going to go down, which means we might see more people invest back into the marketplace. I've had people talking about that already. Plus, if you're coming up for renewal, obviously it's a good sign when we see this happen, especially if you're considering going variable into the future, but it's not a major shift from what we've seen the last few months. The reality is we're in a complex economic marketplace, and the data is dropping week by week, month by month, which is meaning that the bank is making decisions quicker than ever. Fundamentally, another big question that's being asked is how is what's happening in the US going to have a big impact on Canada? We're gonna roll that out with more videos and content in the coming weeks, as the US decision could bring us closer to seeing what could happen and unroll for the rest of 2025. What do you think? Did they make the right move? Did they make it too late, too early? Should they have cut more? I want to hear your feedback. Let me know in the comments below. Reply back and let me know what you think.